Good day everyone, this is Dr. Sivaraman of iknowindices.com. So I'll be doing a webinar today, a twin webinar, which is given once a month, tracking the forex market together. So on July 23rd, I'll be giving the first part of the webinar between 5 and 5:45 GMT, and the second part will be given between 14 and 14:45 GMT. So we will be using the live market code page as a tool for our tracking technique, and subsequently we will relate the current market level to that of the high, low and net changes which are shown in the live market code page, and try to read the intentions of the players before taking any position. So let me give the link for the same. You can open the live market code page in a browser, and I'll fix the camera over at the live market code page and explain to you briefly what is seen in the current market. Currently, euro is trading around 1.2896, 1.2898 level, and the low is 1.2885, the high is 1.2917, the net change is 5% positive. From the start of the Japanese session, they are not breached the high. And in the case of GBP, current level is 1.5287, 1.5291. The low is 1.5254, the high is 1.5288. The net change is 29 pips positive. So when there is a lesser rise in the case of euro when compared to that of GBP, we are able to understand that they are trying to handle euro GBP cross by making a small dip here. So you come across about 12 pips negative net change in the case of euro GBP. Then in the case of USD yen, it was hovering around 87 area, and it has reached that level and come to 86.90, 86.93 today, and 86.74 is the low, 87.21 is the high. A negative net change of 1 pip is seen. In the case of Swiss franc, 1.0434, 1.0437 are the current level, 1.0418 is the high, 1.0435 is the high, about 6 pips positive net change is seen. So if you compare all the majors here, you come across a contrarian move that euro and GBP have gained, and also USD CHF has gained, whereas USD yen is showing the USD weakening move, and all euro and GBP is are also showing a USD weakening move, nominal USD weakening move, but USD CHF is also showing USD gaining move. Then in the case of commodity pairs, you come across Canadian dollar is trading around 1.0386, 0390 area, and you find 15 pips positive net change is seen, which indicates that USD gaining move is shown by that of Canadian dollar. And Australian dollar, yesterday it has gained more than 100 plus pips, and it is hovering around the same level, 0.8924, 0.8927, 0.8905 is the low, 0.8949 is the high, the negative net change of 8 pips seen. So as far as the commodity pairs are concerned, you come across the USD gaining moves are being shown. So you come across a contrarian move altogether, a nominal contrarian move. This is mainly to handle the crosses to start with. Then you find that in the case of the European crosses, 0.8435, 0.8436 are the current levels. In the case of Euro GBP, Euro CHF is showing a nominal upside move of 12 pips. And in the case of yen crosses, you come across a mixed reaction. Euro yen is showing a negative net change or almost zero. And in the case of GBP yen, a positive net change of 21 pips are seen. So what do we derive out of that? And how exactly we will be able to track the market? See, yesterday they made the initial drop, and then subsequently they made the gain during the US session using some attribute, and subsequently they just sustained the level and stopped cutting the high. They have been making the higher level consolidation. And many of the people thought that they will make an upward gap opening and continue to rise. But you come across that there is no significant rise, especially people who are afraid of Australian dollar. And now you find that Australian dollar is making 8 pips negative. So when they gained about 100, 150 pips in the case of Australian dollar yesterday, they know very well most of the traders who have gone short during the drop have done the short covering. Now they are simply holding at a higher level and inducing the traders who have gone initially short to make a little bit of short covering, and subsequently when the traders turn long, they are expected to make the drop. And if you watch this particular quote page, here you will be able to see that they show the green order and there is no follow up green order. So 89.23, 89.26 are the current levels, and you find that it is appearing in green, and subsequently when there is no further buy order above that or an improved order, you find that it is not gaining any momentum. Then subsequently you find this order becomes black. So that means they simply kept the order, the traders are not willing to participate in the market. Then afterwards, if there are some improved buy orders at the lower level, so the fifth decimal level only they are changing it, you can understand? Because of that it appears green and actually not in the fourth decimal. So now you find a follow-up order just by 1 pip above. So when they keep orders like this, immediately traders who are doing scalping will try to buy during this particular condition. And subsequently you find that they remove this particular order and sell it up to 21. So this is how they distribute. See, now it has become red. So this is how they distribute the positions holding at a higher level without cutting the high. Why they should not cut the high? What is the mandate for that? Or what is the why they should not do that? They can always do that upward stopping. When they gained about 100 pips, making another upward stopping is difficult for them? No, not at all. But the main intention is they induce the traders to do the short covering and turn long and see that they are not booking profit. Only then when they drop, they will be able to go for long liquidation at a lower level. So this is how day in and day out they do the moves in the market. So we have to learn how to read the live market quote page. That is more important. Probably in my trading system webinar, I'll explain more in detail about the type of moves they are making in the market, how exactly we'll be able to track it and envisage what could be the move they could do. Now let's go over the PowerPoint presentation. So initially we need to know the timings of the market. So we are in the Japanese session. These are all the timings followed by the other players depending upon the bank treasury closing in one region and other bank treasury opening in another region. Nothing to do with the names what I had given. They are just the name to differentiate the sessions. And you find that the first session is between 0030 to 7 GMT, then 7 to 7:30 GMT. There is a gap time in which the bank orders are not expected to flow in the market. In the absence of big orders for their currency conversion, that is, the big orders normally come from that of the exporters and the importers, those who are in the international business. They normally do the currency conversion. They don't participate in trading. Sometimes they will be needing billions of dollars currency conversion. So they just do it soon after that 7:30 GMT during the start of the European session. Within about 15 minutes it should be over. So during that time, the players will not make any stop and they will try to do the stop or a false move during that other gap time. Using a big order, they have got a specific order called all or none order. So they will keep an order of about 20,000 lots buy at 1.2950 when euro is trading around 1.29. Then it will look for a corresponding matching order of 20,000 lots as a single trade. Nobody is going to keep 20,000 lots as a single trade. So that order will search up to 1.2950 and expose all the stocks. Then they will keep one normal sell order at 1.29, then it will fill all the stops. So that is how they fill the stops. So you need to understand that whether they are doing the stock filling or they are genuinely buying at a higher level. Similarly, at the lower level, are they doing the stop or are they really selling? So you should be able to differentiate it based on the timings of the market. So European session is from 7:30 to 13 GMT. Then 13 to 13 GMT is a gap time between the second session to the third session, which we can call it as a US session. That is from 13:30 to 20:30 GMT. Then there is a 4 hours gap, 20:30 to 0030 next day. And during that gap time only, you find that they make again a false move. So normally during the start of the week, on Sunday night, many of the people find that there is a big upward and a downward move in the market. During that gap time, they make use of such orders and try to hit the stops on either way, the pending orders. So, what is the basic trading strategy we can think of using the live market quote page? So, you watch the market for 30 minutes from the start of the section in all the 6 pairs, the 4 majors and the 2 commodity pairs. Then, if the market is near that of the high or closer to the high, not breached the high for more than 30 minutes, then try to take a sell position. And if the market is near that of the low and not breached the low, then take a buy position. So that is for intraday swing trade or intra-session swing trade. So if they have breached it, then you have to wait for 2 hours. If they breached the low and gone below or breached the high and gone above, then we have to wait for 2 hours in order to take a higher level sell or a lower level buy. That is the only difference between if they don't cut the low or cut the high in 30 minutes. Then we can take after 30 minutes a buy near that of the low or sell near that of the high. In case if they have breached the low or the high during that market move in first 30 minutes, then wait for them to finish the particular stop and they will finish it in 1.5 hours. So to double confirm that, you wait up to 2 hours so that they don't breach in the last 30 minutes the high in your observation. Then take the sell position. You will be able to see a small swing trade profit in it. So that is the difference between waiting for 30 minutes and not cut the low and cut the low. Then whatever you have taken the decision. So our taking the decision or taking the entry decision is just relating the current market level to that of the highs and the lows set in the live market quote page. So you find that currently euro is trading around 1.2902. The high is 1.0917. So it is closer to that of the high. So I explained in the earlier webinar that there are a lot of constraints in the trading platforms and things like that. They may not give a definite fill. So where exactly we can keep a buy order or sell order, because it is near that of the high, not breached the high in our watching from the start of the session. So 1.2917 is the high. So where exactly we can keep our limit order? We can keep just about 3-4 pips below that of the high. So it could be 1.2914. So that even if the market goes to 1.2917, then we will get a definite fill. But we won't be knowing when exactly they are going to fill it. And subsequently, if they make an upward stop and come down, we should not be entangled. So immediately what we have to do is keep an entry stop order. That is a hedging order, 30 pips above our entry. So our entry will be just 30 pips above that of 1.2914. A limit order we keep, and subsequently a limit buy order we keep if the platform offers the hedging facility. The platform does not offer the hedging facility, then you have to keep a normal stop order so that we determine our risk. So I will only take a risk for 30 pips, not more than that. If the market goes against me, doesn't matter. I will just lose only 30 pips. I can afford to lose. And if you keep the hedging order, the advantage is you will be able to review the market in relation to the hedging stop or the hedging position, and you can take a decision whether you can close the original position or the hedging position and continue to participate in the market and try to earn back the last money in case we are hedged. But if you are keeping a stop, then the position is closed. You have to re-enter into the market. And once you make a small loss also, you will have a hesitation. And you'll try to go in for a double confirmation before entering into that of the market. And market will continue to give opportunities, but you will find that you have missed that opportunity. So in order to avoid that, the hedging strategy will be very, very ideal for small traders, so that even if you are not using the hedging, you try to open an account in a platform wherein hedging facility is available. In the event of a very quick rise or drop, you can simply hedge the positions in the market and later on review it, whether your entry is correct, or if you try to close the position and the platform might give slippage, and in that process your loss might be more than what you were expected, unless and otherwise the platform is very honest. So you have to understand the platform provider is very honest. So you have to understand that there are a lot of limitations in doing online trading. So you have to calculate the risk and predetermine the risk and keep the mind cool. Okay, I'm willing to accept 30% loss. In case if the market goes in my favor, I'm willing to book profit. That sort of mindset, if you develop, then the market will not give surprise for you. And this is only to limit the risk. Once the position makes about 20-30% profit, you try to keep stop at entry and remove that hedging order. And if the position is hit at stop at entry, don't worry about it. The position is closed. Doesn't matter. You don't lose any money. Then market continues to give the trading opportunity. And if you find that after hitting your stop, the market has dipped, at the same level, you can keep a limit order. They will try to fill it and again keep a hedging order. And it doesn't make any difference for you as long as your margin is protected. So protecting the usable margin is very, very important. And it is a hard-earned money. You cannot just like this speculate and lose. So that should be your conviction when you are entering into that of the market. And once you become addicted to trading, then you think that the position becomes very precious and you do not want to close the position unless and otherwise the profit is seen. Then invariably your waiting period gets dragged and you start questioning the various analysts in their blog or sending emails, etc., and asking them what could be the possible move in the market. In the process, the analyst will give varied opinions. Some may say that it can come down and some may say that it can go up and things like that. Ultimately, whoever is giving the call in your line of expectation, you will think he is a great man. Then the very next moment when the market goes against you, then you start yelling at that particular person. So this is what happens because you expect others to think on your behalf, and when that particular thinking becomes a failure, then immediately you say that because of that man I incurred a huge loss. But actually you are taking a trading decision, enter into the top of the market, and you are expected to handle your position. Nobody else will be able to handle your position other than yourself. It is password protected. So obviously you have to understand that you have to take the appropriate measures. So once the position makes profit, you have to keep stop at entry so that your risk is minimized to nil. And keep about 30, 45 or 75 pips limit so that when the market moves in your favor, you can move away the limit and you can trail the stop, convert the stop into a trailing stop, and automatically the trailing stop might be hit or your limit might be hit by the market. And finally, you will be able to see that the profit is assured. And that is the most important thing in the basic trading strategy. So if you understand the basic trading strategy, then your mind will be able to find, okay, what are the other type of modifications I can bring in this particular strategy? And what are the other advanced strategy I can go for? But if you do not discipline yourself with some basic trading strategy, then you will find that no trading strategy works for you. Because you will be always looking for a crisis management rather than a pre-planned arrangement or a pre-planned system to be executed or implemented. And this is very important in any business for that matter. If you are starting a business, obviously you have to see that your infrastructure is good and your communication is good and your advertisement is good and your product is of up-to-date nature, and you are also in a place, the strategically located position, so that you will be able to get the customer success. So all these things are to be planned before opening a shop. So it is not just like that, no, in my place only I'll open it, people come and buy it, okay, fine. Otherwise I am not interested. If you try to sell like that, I don't have any proper system. And if the people want vegetables, I'll sell vegetables. If people want some grocery, then I'll sell groceries. If you go on change, then you will find that your strategy does not work. And the customers who come for vegetable find that you are not selling vegetable, and they will find that grocery is being sold, then they will go away. So you will be simply losing all your contacts just like that. So obviously any business for that matter, you need to develop a system and stick on with the system and try to bring in modifications to the system based on your experience. Then it will be a learning experience for you. It will not become a costly experience of losing money later on learning from that of the loss. Now, what is the forecast for this particular session? In this session, Euro and GBP are expected to next swing slide. So I'll be giving you a live trade call, and also we will be reviewing such calls on the trading positions, what happens to those positions during the part 2 of this particular Tracking the Forex Market Together webinar, which I'm going to present it by 14 GMT. So I'll review the calls and give you the up-to-date how exactly I handle the position. So coming to that of taking the positions, as I explained that we will keep only the limit orders near that of the high SL order or near that of the buy order, and we envisage based on the forecast that Euro and GBP are expected to slide, but they can go against us. There is no 100% guarantee that the forecast has to be always correct. So we have to use the trading technique to limit the risk. So I will keep a limit order. Sell 1.2914, just 3 pips short of the high, because the platform may not give a definite pull. So we can try it out in a demo trading platform and see whether the system is really working. Okay, don't straight away enter into that of the real trading account and later on, without knowing how exactly to handle, you should not become panicked. Then there should be an entry stop of 30 pips. That entry stop 30 pips will be just 30 pips above that of 1.2914, so it will be 1.2944. Then in the case of GBP, the high is 1.2993, so we will hit here sell limit. $1.5290 with an entry stop. So, and I am just giving you the calls in all the currencies. It doesn't mean that you have to simultaneously keep orders in all currencies, because your equity may not permit, and it is not advisable just to decide that all the currencies are going to fall. Okay, so whatever the currency you are familiar with, whatever the currency you find there is a great potential of volatile move, then in such currencies you can take the position, and once you are able to keep stop at entry in that particular currency, then you can think of taking position in another currency, so that if the market goes against you, only in one position you will be losing money, not in all positions. So always envisage the risk and try to trade accordingly. Then USD currently it is trading around 1.0433. The low is 1.0418. The high is 1.0435. The net change is 4 pips positive, and Euro is making a net change of 15 pips positive. So they are just making a little bit of contrarian move there. So I'll keep near that of the low a buy order. buy limit 1.0421. 0418 is the low. So I'm just keeping 3 pips above and an entry stop of 30 pips. Then in the case of USDN, the low is 86.74 and the high is 87.21, and I'll keep a buy limit order. $86.76, the entry stop of 30. Then Australian dollar has gone higher, and doesn't mean that it has to be bullish all the time. So the levels continue to change, but we have to read what is the intentions of the player and accordingly take positions. Whether you sell it at 89 and book it at 88.50 profit, or whether you sell it at 88 and book profit at 87.50, doesn't make much difference for you unless and otherwise you think that the levels are important. You continue to make that 50 pips. So we should not give importance to that of the level, and we have to give importance to that of how exactly the net change is, what they are trying to do. They have not cut the high, and so obviously they are trying to distribute their positions, what they have purchased at the lower level, and that is why they are not cutting the high, so that they avoid giving profit booking opportunity for that of the traders. So initially they will make a dip, and those who have got long at a higher level thinking that it can go to 0.90 might be stopped out. Then subsequently they may rise. So during that downward move, you have to keep stop at entry and trail the stop and try to book profit. So every time you will come across the market will show intraday trend reversal moves. So you should not blindly take a position and simply hold it and say that I was expecting a big drop, whereas suddenly it has gone up, and continue to experience surprise. Then such surprises will trigger your emotions, and invariably you will become an emotional trader, distressed trader, and you will end up when the usable margin erodes, and also when they charge interest when you hold it for a long time, you become more and more panic. So this is how the game plan is being set. So you have to understand, and you should not become a victim of the end of it. 0.8949 is the high, so I'll keep it 0.8946 as a sell limit order with an entry stop of 30 pips. So if they fill my order, fine. If they are not filled my order, I will wait for another opportunity. I will simply, once the session is over and the orders are not being filled, I will try to remove the orders and look for the next session. Wait for 30 minutes from the start of the session. That is 7:30 European session start up to 8 GMT. I will wait, or 8:10 GMT, and see whether they are breaching the low or the high. If they are not, then I will try to take a swing trade, sell near the high or buy near the low. So this should be that approach. So if it does not give that profit booking, entry level opportunity, feel happy that I have not taken any risk in the market. So let me wait for a good opportunity and try to enter into the market. I am not willing to enter into the market in the middle level when it is. And that should be the commitment, and that should be the conviction of the small trade. Then in the case of Canadian dollar, 1.0380 is the current level, 1.036 is the low. And so I'll keep a buy limit order, 1.0367 with an entry stop of 30 pips. Okay, these are all the limit orders, and we will see how exactly the limit orders act during the course of the webinar and also during the session close. Now, this particular session I started around 5 GMT. So obviously it is not 30 minutes past the start of the session. So obviously I'll be waiting for the late sessions, that is between 6 and 7:30 GMT, between 6 and 7 GMT. how exactly they are going to handle it. If they are not filling it, probably I'll try to modify the sell limit order as 29, 1.2911 or 1.2909 like that, but not lower than that. Okay. If they are not filled it for, in my observation of 30 minutes during the late session, because I am trying to take the positions in the majors and I know very well they will be very active in the majors during the early Japanese session and the late Japanese session. The first 1.5 hours and the last 1.5 hours, each of the session timings I have given. So during that time, whether they are filling it or not, I will watch. And not during the mid session. If they are not filling it, I will not modify. During the late session, if they are not filling it, then I'll try to modify and try to see what happens to that. Okay. In the event if the position is hedged, what I can do? I'll just wait for 30 minutes. If the market has filled my limit order and gone above and filled my hedging of 30 pips, I have not lost anything. I have only blocked the 30 pips. And if it is a standard lot, then I'll be blocking about $300 in that 1 standard lot. Then obviously I'll have a high level buy and a lower level sell. Still, I will be having the position to trade, participate in the market. If I simply keep a stop, then probably they will fill the stop. I won't be having any position, so I have to think of entering into the market fresh. But if you develop a strategy of how to handle the hedging and try to book either way, because the market has got only two possibilities. Either it can go up or come down. All the days it cannot go up, all the days it cannot come down. Okay? So probably about 2-3 days it can go up, doesn't matter. And it has to come down, at least to some extent. And that time, I'll be able to book profit or cut a nominal loss in my unfavorable position. And if I book profit in my favorable position, if the hedging happens to be a favorable position, and if they continue to rise up to 1.30 or 1.31, doesn't matter. I'll just wait and try to book profit when they stop cutting the high, the next session or the next day or the next week, whatever it is. Then afterwards keep 30 pips above. Still I'll take only risk for 30 pips. So when it is a buy a hedging order, I'll try to book profit near that of the high set for the day. And if it is a sell hedge order, I'll try to book the profit near that of the low set for the day. So that the pullback will happen from that of the low or the drop will happen from that of the high. Then I will be able to see that the trailing hedging order can be used and which can bring down my exposure to that of the market, and the usable margin will be returned from that of the blocked level. And once the position makes profit on the sell side, I'll continue to use the trailing stop on the downside and book the profit as well. This is called either way trading. So I will explain to you more about, with regard to the crosses, I will not take the position because already it is about 5:30 GMT. So let me spend more time with regard to answering questions and also explain to you with regard to advantages of hedging. See, hedging is used instead of a stop because you need to understand the importance of hedging, and whether you use the hedging or not on a daily basis, still you try to open an account in a platform wherein hedging facility is available. So in the event of crisis, suddenly you find the usable margin is getting eroded and you can simply hedge to the market and just wait and later on pump in more money and cut the hedge and continue to trade. Otherwise, you will be forced to close the position. Invariably, if you are holding more position, there are traders who have the tendency of taking about 5 lot positions, and when the going is good, book a partial profit and then further partial profit, then finally close it. They based on the studies. And suppose you have got a 3 lot position, you have straight away taken it, and your usable margin is about say $5,000. Then you have taken a 3 standard lot positions. Okay, when the going is good, everything is good. But if the market starts moving against you, you need to keep the stop. And if you fail to keep the stop, and that too if you keep a stop of 150 pips or 200 pips, thinking that risk-reward ratio is to 1:3, so I am taking only 150 pips risk, whereas the profit is 450 pips. If you just imagine like that, they may probably hit your stop first And later on, they may go up to that of 450 pips, but you are not in the market. Whereas if you use the hedging, then if you are hedged, doesn't matter. You can review that and see, okay, I am hedged, but the hedging is making loss. So probably during an extended downward stop and my hedging has been filled, I'll book at least 10-20 pips loss in that, doesn't matter. So I'll trail the hedging order upward till I am able to keep stop at entry. Then afterwards the market is moving in my favor, I am able to do as per my plan. So you have the plan, but you have to need a contingency for the plan, because any plan we envisage or any plan we just work out, it may not, or we try to execute, it may not work out 100%. There will be so many ifs and buts. So in the event of the something which goes against us, we should be in a position to handle the situation without any hasty condition. That is very, very important. For that, you can use the hedging. And there might be, if you contact any of the trading platform, say that, do you have that hedging facility? Then immediately that marketing man or a deal room man will say that, no, if you use hedging, that means you do not know how to trade. And you will be thinking, oh yeah, that might be true. So I do not know how to trade. So that is why they have safely removed hedges in US platforms. So you'll be thinking that they are wise enough. You open a trading account with any of the trading platform providers, and the commercial people will be talking to you so nicely. They will say, we'll give you bonus and things like that. And once you open that account, then the way of talking they are going to make, and they may not even address your call and simply say that there are thousands of clients waiting, so I cannot listen to you for a long time. Tell me quickly what you want. Then you will say there is a slippage. No, sir, there is not a slippage. And that's how the market moves. You have to accept. Simply you will cut the phone without even listening to you. So that is how their treatment will be from that of the deal room people. Okay. So if you use the hedging, then you need not bother about them. So if you use the hedging, then they will simply hedge you. Doesn't matter. There might be a slippage. Still, you'll be able to understand, okay, if the hedging makes a nominal profit, if I'm able to keep stop at entry in the hedging and closing, it's fine. I am not incurring any loss. Instead of 30 pips blocking, I would have blocked 35 pips. Doesn't matter. If the market dips another 5 pips and later on it is not showing any profit to my holding hedging order or hedging position, then I keep stop at entry and close it, keep 30 pips below another hedging order. When the market moves in my favor, I try to trail the hedging order upward and try to maximize the profit. Okay. So we have to understand the constraints what you could face during trading and plan ahead of such constraints, so that in the event if such constraints come, just laugh at them instead of fighting with them. Because you need to focus on your trade rather than just yelling at the platform provider or the forecast provider. That doesn't help you, and you have to smartly earn money out of this situation. So it is something like when you are carrying money and going to the subway, and obviously you know that there will be a lot of pickpocketers, and you know very well, and it is up to your responsibility to safeguard your money rather than telling that there are so many pickpocketers in this particular place, so I will avoid going to the other suburb or subway. If you try to think like that, then it is extremely difficult for you to survive in this world. So there will be a lot of criminals around us. We should be able to tactfully handle, and we cannot rub against them. We can only tactfully handle and just escape and survive. Then hedging is used to continue to trade when the market moves in our favor. So suppose you have got a hedging order got filled and you simply wait, the market has gone again. Suppose yesterday somebody has taken a sell position at 1.28. Just imaginary level I am saying in the case of euro 1.28, I have taken a sell position. Then subsequently 1.2830 it got hedged. The market went up to 1.29, 1.292. I am not worried. Let them come. I'll keep stop at entry in the hedging. Okay. After filling the stop at entry, they may continue to drop. I'll keep another hedging order above that, and then try to, as soon as it is filled, I'll keep another hedging order. In case if they pull back, then I should not become exposed. So I'll keep another hedging order and trail it down as they move downward. And till such time, I'm able to keep stop at entry in my sell side. Then afterwards, if the profit comes, I'll continue as a trailing stop and keep the limit and try to book profit. So if you don't keep the orders, don't think that the market will wait for you to book profit. You have to keep the limit orders as well. Many people have got the tendency, okay, let me just maximize the profit out of greed and simply watch, and they would have made a very good move in your favor, shown 150 pips profit. Then you will think that let them go a little more higher, then I'll book the profit, but they will come down, and afterwards you may not see them going up. See, what is the necessity for them to show you profit again and again? You tell me that is not the objective of the players. The players want to earn from you. So during the stop end, you would have seen some profit, but if you fail to book it, then you will see that you are not in the market again. Then hedging can be used to reverse the trade when the other way going is very good. Say for example, I have taken 1.28 as sell position and 1.2830 is a buy position. By hedging order is filled and the market is continuously showing profit. I am keeping stop at entry. I am just waiting for about another 2 sessions. It is not coming down. Then the hedging is making about 40 pips profit. The selling is making about 70 pips loss. I don't mind cutting the sell position with 70 pips loss because I am still protected with 40 pips profit. And I'll try to keep the trailing stop in that, see that at least 30 pips or 40 pips being protected. Then subsequently, when the market moves in the opposite side, I'm participating in the market using the hedging order, hedging position and try to maximize the profit. So either way you can participate in the market without losing much of a time and expect the big players to move in your favor. Are they going to listen to you? Not at all. They are going to act against the herd of traders. So if the analysts say that it will go up, are they going to take it up? Or if the analysts say that it is going to come down, are they going to drop it? Not at all. These are all nothing but the expectations, or we can just give the forecast. But there's no guarantee that within a short time of 1 day or 1.5 days, that market is going to reverse or market is going to show that level for you to book profit. So you have to patiently wait in the event if you are holding a position for a long time with a hedged condition. And you will be able to see the profit will be shown on either side and you will be able to book profit. At least you can keep stop at entry and try to move. Whenever the market moves in your favor, you can book profit. So there comes your skill set and the patience. I always say that market rewards patience and it punishes the impulsive trade. So try to see whether you are impulsive or you are calm-minded. Then hedging is used to hold the position and continue trading when time permits. In the event of emergency, you can just simply hedge the position at the market and just go and attend it. After about 2 hours, you are coming back. Okay, hedging is making about 5-10 pips loss or even 60-70 pips loss, and the original position is making the profit. So you will see that still you will be blocking about 30 pips. And there will be a shortage of 30 pips. So the buy will be making about 40 pips and the sell will be making about 70 pips loss. So still the difference is only 30 pips. So you cut the sell if you find the going upward is good. And then obviously when the market gains another 30 pips, you get a break even. And you don't like any of those trades. You are able to come after only 2-3 days. You can simply close the original position with a hedging, accepting only 30 pips loss. So there is no unexpected loss. So if you use the hedging, there is a provision in the platform that close with the hedging concept. That event is there in the platform. If you click it, then it will close your original position with that of the hedged position, so that you will have only 30 pips loss. The loss is predetermined. So what a great advantage you have if you use the hedging. Then hedging is used to hold the position, continue trade when the time permits. That's what I explained. Then hedging can be used to close the position at any time frame. You are not able to attend it. If there is a calamity happened in that, or there is a big eventuality happened in that particular place, you don't have the internet connectivity and things like that. And if you are hedged Okay, doesn't matter. You already kept the hedging. Market either would have hedged me or just would have gone against me or shown me profit. There are the two possibilities. So we just watch once the facility is available, see what is the condition, then simply close the position with that accepted loss. So I explained in yesterday's My Trading System webinar, between the cup and the lip, anything can happen. So don't take chances. Then hedging can be used to spread the risk with the limited risk in each position. There are so many people who try to do the averaging trading. That is, they try to do the averaging by taking every 50 pips drop or 30 pips drop, they try to add buy position. And once that rise happens, then immediately they try to close all the buy positions above their average or just book at the highest level. So many people have got the tendency averaging will work. But the market has got a potency to either drop or rise 150 pips in a given day on the upside or on the downside. That means it has got a potency to make a spread between the high and the low as 300 pips in a single day. Can you afford to take that much risk without a stop or without a hedging? Yesterday you would have noticed that they dropped, they made the quick moves. That is what I was mentioning in the blog. They are expected to make very quick move on the downside as well as the upside. Exactly they did it. And downside they made about 100 pips and upside they made about 150 pips. And you find between the high and the low is about 200 to 250 pips spread. But how to participate in such moves? By changing your mindset, it's extremely difficult because it is next to impossible for any human to quickly change the mindset from bullish to bearish, bearish to bullish and things like that. Only if you use the trading strategy, that you realize that the position is being filled. The hedging is being filled. Okay, the market is making a move in the other way. It is sustained above that of the high. So it's going to rise further up. Then probably what you can do, you can simply cut the hedging and try to book profit on the buy side. Cut the original position and book the profit on the high side, on the buy side. So this way you should be able to determine which way I am going to trade and whether simply averaging will work. In the event if you are going for an averaging, then every 150 pips you try to take a buy position, not every 50 pips, every 150 pips, and keep in every order 30 pips hedging order. Then keep orders in your platform for about 600, 700 pips and close the platform, attend to your work. If you are a position trader, keep only one mini lot as each order when the equity is more than $20,000 to $30,000. Then try to keep all the orders up to about 1,200 pips on the downside as well as on the upside. Then you will find that once you open the next day, the platform, either some position will be making profit or some position might be hedged or some position will be making loss. These are all the possibilities. And you will be able to wait calmly and you will be able to really see that you can book profit. When they make an extreme move, then close all the hedgings with a profit, and when they go a pullback of 50%, then close all the other way positions above their average. You get the money. So you need not do any sort of market analysis, any sort of trading techniques or any sort of technical analysis, fundamental analysis, because they cannot bring Euro or GBP to zero or to infinity. Then hedging can be used for breakout trades. In the event there are many people who are interested in using breakout trades. That once the high is cut and the market goes above that of the high, you try to take a buy order and try to quickly book profit. And you don't envisage. You simply keep a stop below that. Instead, if you keep a double hedging order for one lot buy at a higher level, you keep two lots sell orders. Then if they drop, then one position will be hedged, the other position will be making quick profit. You can book the profit and review what happens to this particular position. Either you simply close it with 30 pips loss, the other position would have made about 70, 80 pips profit. So at the end of the day, you have about net profit. So you can use the trading strategy more effectively so that fine tuning of the market reading is not very essential. then hedging can be used without additional margin, because in most of the platforms, when you use the hedging, they don't take extra margin for the sell side or the buy side. Okay, so these are all the advantages of the hedging. The disadvantage is, if you do not understand how to handle the hedging, you will be struck with a buy as well as the sell position. And simple solution is simply close the position. That's all. Anyhow, if you keep the stop, you are going to incur the loss. Hedging does not make that as a bigger loss. So try to develop the mindset when the loss is small, accept it. Then you will be able to effectively use hedging. So you come across already, they had dropped and they cut the low, and GBP also they had dropped as envisaged by the our forecast, but they are not given the definite fill for us, because I kept the orders only by 5:15 GMT, and then we have to see still whether the order can get filled, because these are all nominal swings. Probably they may make a brief downward shot and then come and fill my order also, limit order. Only if they fill my limit order, I will continue with the trading. Otherwise, simply close the orders. And the next session, I'll review the market, wait for up to 8 GMT, and review the market and try to take the position there. Okay. So this is how one should be able to understand how exactly you can plan your trading. So planning the trading, you need not think that it has to be necessarily complicated. Only then there will be a success. It is not at all. The plan can be a very, very simple plan. Even a child should be able to execute that particular plan. That sort of strategy one need to have it, because the big players have similar such plans. Very simple plan, and which can be easily executed, and they don't make it very, very complicated at all. It may appear that when every analyst is talking about stochastic MACD and moving averages, weighting moving averages, then also you come across the correlations, etc. You understand one thing: by simply complicating the analysis, the confusions will also be very, very complicated, and you will not be able to get a resolution of that. Okay. So I will just minimize the PowerPoint presentation and take up the questions which are asked here, and later on conclude it, because there is no subsequent webinar. I think I can take about another 5-10 minutes to answer the questions. Focus slide is only for this particular session. I will display the okay, I forgot to show one of the slides. That is, on a daily basis, I show the initial low and the high set for day. So that we'll be able to really understand, those who have been regularly attending the Asian session live market analysis, we'll be able to understand what happened to the lows and the highs. So let us just compare quickly the lows and the highs set for today and what happened to them. Here was initial low was 1.2885, then high was 1.2917. Okay, they cut the low. Now currently it is about 1.2867. And if they don't come above that particular 1.2885 in more than 30 minutes, understand that they wanted to make an extended downward move. In that case, as I explained, you can take a sell position below that of the low, like 1.2880, then keep a hedging order 30 pips above. And once the position makes profit, keep stop at entry. Then try to run with the profit. So they cut the low in the case of 0, and they come closer to that of the low exactly, made a false move. They did not cut the low 1.5254 in the case of GBP, and they cut the high in the case of GBP. 1.5285 was the initial high, and the current high is 1.5293. Then they cut the high as an upward stop, and they come up to that of the low, and they are expected to go up to that of the high and then drop it. Understand that they wanted to drop Euro GBP today. By reading their moves, you can understand what is going to be the next play for us. Then, in the case of USD CHF, 1.0418 and 1.0435 are they cut the high. 1.0435 was the initial high. They formed a new high, 1.0446. Understand they wanted to gain the levels in the case of USD-CHF. When euro was dipping, they gained the level. When euro was positive net change, USD-CHF was also showing positive net change. So they do not want to drop USD-CHF. Instead, they want to rise. They cut the high. And if they stay above that high for more than 30 minutes, you can take a buy above that and keep a hedging order below that of the initial high. And once the position makes profit, keep stop at entry and try to run to that. Then in the case of USDN, 86.74 is intact, 87.21 is intact, and probably towards the close of the session, they could be handling the yen in order to handle the yen crosses. Then in the case of Australian dollar, you find they breached the low. 0.8905 was the initial low. The high was intact. As I explained, they have not cut the high since the start of the Japanese session, and they have breached the low and formed a new low, 88.99, and just come above that of 89.05. If they sustain above 89.05 for more than 30 minutes, understand that it was a downward stop and before making further rise. So this is how we should be able to understand that. And even in the case of euro, and if they come above that 28.85 in less than 30 minutes, then understand that they are not going to drop and they wanted to make an upward swing. So following their move, near that of the high and near that of the low, you can determine what is going to be the next move. But only thing is you have to patiently watch during that particular time. And always watch your live market code page, note down the time, up at what time they are just cut that. You need not have a wristwatch to see that or a stop clock to see that. You can simply use the live market code page. Okay, about 5:55 GMT they cut it. So I'll wait up to 6:30 GMT, and if they are not come above that of the high, come above that of the initial low, in the case of euro, they are going to drop it. So that way you can understand. In the case of USD CAD, 1.0362 and 1.0407 is the new high. So they cut the high and formed a new high, understand, and they are seeing above that particular high, 1.0390. They sustain above that, then there is a great potential for it to go upward in this session, and they could follow it with the next session. So today I am expecting the market is to make range bound swings. So you know that there are a lot of higher level buyers around 1.30 in the case of euro, and there are lower level sellers around 1.28 and 1.27, and obviously they will swing in the nominal range of 70 to 100 pips and try to induce the higher level long sellers, higher level long holders to liquidate with a loss, and the lower level short sellers to do the short covering and incur loss. And ultimately, the players are expected to make money by simply holding the market without making moves. That is what expected for the weekend. I'll put it in the blog. Okay, let me minimize the PowerPoint presentation and take up the question. In Francisco, do you think Australian dollar can make a big drop weekend or next week? So today they could make a nominal slide to 88, and then next week will come up as a drop in Australian dollar. Balanced euro yen is stronger than good job, but it shows GBP strengthening. Is that not a paradox? No. You see that euro yen is showing a negative net change and GBP yen is showing positive net change. You can understand that GBP they wanted to hold and drop euro to start with, and then subsequently they will drop euro. GBP. Then drop off. Are you using the standard time or the daylight savings time? See, I think many of the people have not understand that GMT does not have the standard time or the normal time and the daylight saving time, etc. GBP time is constant throughout the year. GBP time, Greenwich Meridian time, is constant. Okay, there is no change, there is no shift in that. And when the sun rises early, during the summer, we only adjust our clock 1 hour ahead and try to save that particular time available for our job. That is why it is called daylight saving time. Okay, so GMT does not get altered. So that is why I always say that you track the market following the GMT time rather than trying to take the market to your local computer. No, if you think a global phenomena, you try to bring it to your local condition and try to read it, you will not be able to understand anything. Instead, let it be global and you try to perceive it as a global phenomenon. See, whether during your sleep also the market is active, right? And just because your evening has come, the market has not stopped making moves. So try to participate in the market when it is global using the global time frame. So you follow the market using the GMT time rather than just looking at your local time and try to do it. If you want to identify what time I can be available for Japanese session, European session, etc., you just compare the GMT time to your local time, which is shown in the computer, in the OS. And if your local time, say for example, it is about 12 p.m. or it is about 11 p.m., then understand that, okay, when it is 11 p.m., for me it is 5 GMT or 6 GMT. That is how you try to relate it. Then track the market only using the GMT time, please. Only then you will be able to really participate and earn money from that other market. If you think the GMT has got the daylight saving system and things like that, you have to brush up your geography. And see, people should have a tendency to go in for the search, because nowadays, earlier days, we have to refer to the dictionary, refer to the books and things like that. Now everything is available online. When you are trading platform using the online system, why not you go in for a search in Google or Yahoo and find out what is GMT and see whether GMT has got a daylight saving system or not. And this way, you have to prepare yourself rather than asking some of the basics. When everybody is talking about the currency, then balance it. Euro yen strong. I don't mean that you should not expose your ignorance and things like that. I'm not ridiculing such people, but you have to do little bit of hard work. Okay, you have to have that inquisitiveness to learn everything. Otherwise, in a private conversation, ask people. Otherwise, search in Google search that, okay, what is GMT? Whether there is any daylight saving system, or Wikipedia, you search what it exactly it shows. Then read all those things, please. And you have to do a little bit of homework. Everything will not be cooked and served to you just like that for you to eat. We are not in the royal seat. Understand our situation and try to act accordingly. Then balanced. Euro yen stronger than GBP yen. It's not a paradox, and they are expected to move one by one today. It's all small swings. Where to place the hedging order? The hedging order will be 30 pips away from that of the original position. If you have got a sell order, then 30 pips above you can keep the hedging order even though it is not being filled. Even though original limit order is not being filled, still you can keep the hedging order, and only if the market goes against you about 60-70 pips from the current level, then both will be filled. That event also, you can easily handle the situation. Simply cut the sell position and maximize the profit in the buy position. You have to select the appropriate trading strategy and try to earn net profit from the other market. Okay, therefore, when a hedging order is activated and the movement of the price changes direction going in the way we thought at the beginning, how many pips would you wait for? See, understand one thing, that when they start making an upward rise, don't think that they will continuously rise the market. This is a very wrong attitude. They have to swing. They have to induce the traders to commit wrongly. And they have to see that those who have taken the positions along with them book profit at a lower level. So they will always create the false move for about 30 minutes. In the process, we should be able to exit out of our hedging or the original position. Only if you are impulsive, just looking at the market, oh God, a blue candle has formed, then your mind is blocked. Then you will not be able to think which position you are in. Don't control your emotions and don't become surprised of the market moves. Then you will be able to really handle it using your judgment. Yeah. What expected for the European and US session? Euro and USD. Australian dollar. Okay, Yazar has got the position, so he is only focused only with regard to Euro and the Australian dollar. And that attitude should change. You should see the broader aspect of the market so that you will be able to really derive by yourself. And they are expected to slide during that European as well as US session with little bit of pullback, but they are not expected to make a very big pullback. Then we see to bottom. If you are hedging the position in your hedging entered at the same price you showed for the limit order. No, see, it is not advisable to take the position buy as well as sell position at the same level. That is not a good strategy. It may not work very well. And especially if you are a very impulsive trader, it will not work very well and you will be booking losses in both the positions. Because when one position is making profit, your other position will be making loss. Immediately you will think that, okay, let the other position make profit, then I will close this. Then the other position will be making profit, the first position will be making loss, and you will become just stunned. Yeah, Rob, I explained European session, they are expected to slide, swing and slide. And US session, a drop and swing are the expected moves. I'll give it in a blog. Today it is expected to be a very narrow range swing when compared to that of estimate swing. They will try to hold it between the high set for the week and low set for the week. Between that level they will be oscillating. So to either side, those who are holding unfavorable position will try to close. Then you will ask me what will happen on next Monday. I know very well. Next Monday they are expected to make a false move, a quick drop during next Monday, then subsequently they are expected to gain levels for the last week of that. They are expected to make more volatile moves. Is the current dip in the stop and only? No, still Euro, as far as Euro is concerned, it has not come above that of 1.2885. I have shown the initial lows and the highs. See, you have to do the homework of making note of the initial lows and the highs, sir. You cannot expect me to note down all the levels and display to you on a daily basis. And that will become a spoon feeding. No, because everybody has got a limitation. So you have to understand that and you have to inculcate the practice of using it. If you find the system works for you, you have to put in hard work towards that. The forecast I explained today in this Japanese session only I have shown the forecast. It is swing and slide moves. And European session again swing and slide. And US session also a drop and then small gain of the expected moves. I'll show the order slide. I have only kept limit orders near that of the high in the case of numerator currencies. In the case of the denominator currencies, near that of the low, the limit order. Do you expect GBP to go back to yesterday's low? Yeah, or below? Yes, there is a great potential for GBP to slide after Euro slide. Will Euro rise or drop after the stress test? You watch. According to my forecast, it is expected to slide. So let me show that. Okay. Somebody asked for the forecast. Euro and GBP are expected to slide. Swing and slide in this session. Next section again there is a small pullback and then slide. In US session there will be a slight drop and then gain. They are all going to be narrow range swings. And the position somebody asked for what are the orders I kept. You can take a screenshot or make a note of it or enter it in a demo trading platform and see what happens to those. And these are all the orders only pertaining to this particular session. Since I had taken during the late session, I am just trying to hold it till start of the European session. Afterwards, I'll just close it. Okay, let me show the last slide. These are all the points pertaining to the advantages of hedging. Don't think that I am not displaying the disadvantages of hedging. The disadvantages are very, very limited. And when the both the buy as well as the sell positions are hedged and the market is in between that particular level and both the positions are making loss, then you will think that your loss will be double. It is not so. It is the loss between the higher level buy and the lower level sell only. Still, it will be 30 pips or 50 pips wherever you are hedged. But still, at that time, don't act and don't try to close it because the market cannot be stagnant there forever. It has to make either an upward move or a downward move. Then, once they start making the moves, if you wait patiently, you will be able to book profit on the sell side as well as book profit on the buy side. That is why I always say that take only position for 1% of your equity and keep hedging. So in case if it is hedged, keep the limit of about 100 pips on either side and just watch. You will see both the positions are being closed into 1 or 2 days. See, you can really make your trading system as simple as possible. But you think that it is very complicated and it appears like very complicated. So we will review the calls during the US session. Again, I'll come back by 14 GMT, 30 minutes past US session, and review what happened to that. Of the limit orders I have placed now, whether they are filled and they are not just removed, or I have taken the modified position in the European session. I will explain all those things. And in case if the position is hedged, I will show you how exactly I handle the position with the descriptions. Then you will be able to really understand it is not a difficult task handling it. So you can place the orders in a demo trading platform and don't later on comment or yell at me that the trade has gone wrong and things like that. These are all you are trying to learn and you perfect it using your thinking ability, your reasoning ability, and then make it as a perfect system and use it for your trading. Because this is one of the trading strategy I am just explaining it. According to me, it is a basic trading strategy. There are other modified trading strategies and advanced trading strategies which are beyond the scope of this particular webinar. Okay. So we'll meet again by 14 GMT. Thank you for your patience listening it. Please come back by 14 GMT so that you will understand the whole concept of this particular trading strategy. Thank you, one and all. Thank you.